bit tough for a number of African countries to get concessional loans at this point in time because many economies are not doing fairly well, and the number of concessional lenders like the IMF and World Bank seem to be pedaling back over a number of reasons. Now, it's in this breath that African countries, using the platform of the Kenyan Climate Summit that happened recently, now are pushing for an expansion of the special drawing rights by African countries from the International Monetary Fund. They want the special drawing rights to actually be expanded to about $650 billion US, but the drawing rights, normal drawing rights, to be again expanded to about $100 billion US. Now, they want this money to be channeled through continental concessional lenders, the Africa Development Bank. It is Money and Markets. I'm Charles Ford, your host. Welcome to the show. Now, there's been a fairly general consensus among pundits that the country, or Uganda, needs to look inward if it is to achieve sustainable growth and development. And one of these sectors that are critical for seeing this country realize that is manufacturing. Now, in this segment, we're picking one of the captains of business to find out how critical this sector is and what players, like, for instance, those in the banking industry or financial sector, are doing to help handhold this sector.
I think what is key to note is that as an institution and as a bank, what we try to do, not what we try to do, or what we do is drive what we call a sector-led strategy. So pivotal to that is identifying key sectors of the economy, identifying who the key players are in those particular sectors. So for manufacturing, obviously if you look at the overall landscape and shape of the Ugandan economy, one of the things that you will note is that industry accounts for like 26% of GDP. And if you bring it home, say, to manufacturing as an overall contributor to the economy, it's close to 20%, right? So what therefore that tells you is that there's a great opportunity in the manufacturing sector. So as a bank, what we have done is we've segmented the market into industries, into sectors, into customers. And what we have realized is that when you look at the manufacturing sector, it provides a great opportunity to stimulate growth, of course, from the industry perspective and also from an economic perspective. So as Absa Bank, that's a critical area that we do support with various products that we identify as relevant to drive growth in the manufacturing sector. So I think critical for us in terms of supporting the sector, obviously, is coming up with products that meet the needs of clients. You've rightly said they need CapEx requirement, they need working capital requirements. So from an Absa perspective, what has been critical for us is to bring skill sets that understand the various sectors and the needs of our clients. So we've tailored products that are relevant. Say, for instance, if you have working capital requirements, we've got a suite or spectrum of products that would look at to say, based on your needs, our assessment of your ability to repay, our assessment of your business case, what are the relevant products that are, necessary to facilitate your working capital. So from a bank perspective, we are able to sit with our customers in these particular sectors. If it is a CapEx requirement, we will need to understand what exactly is a CapEx requirement for. Is it to expand production? Is it to improve the quality of your products? And does this infusion of this particular capital to you then necessitate or provide a base for you to be able to generate sufficient cash flows to expand your business and, of course, most importantly, service your obligations? So what we've done really is ensure that we have products that are suitable to financing working capital and also capital expenditure. So that is the manner in which we support growth of this particular sector. So I think the starting point in addressing that particular question is to say, when we look at the trade, say, imbalance or trade opportunities between South Africa and Uganda, obviously we are in a net importing position. And that simply means that on average, on an annual basis, I think the last statistics I looked at, we trade, we export about 60 billion worth of goods annually to South Africa and import in excess of 500 billion. So obviously that tells you that there is an imbalance which is tilted in favor of South Africa. So what this does do is present an opportunity for us to bridge that gap. How do we bridge the trading deficit between ourselves and South Africa? And I do believe that that therefore says that as we look to expand the manufacturing sector and tying that into, the national agenda through, monetizing the economy by providing new market access. So for me, it presents an opportunity to expand our manufacturing base as a way of, stimulating that particular growth. So identifying a big market such as South Africa. South Africa is, I think, one of the top 5 economies on the continent. So by harnessing this trading relationship between ourselves and South Africa, it creates a solid platform for us to be able to expand our manufacturing and export base. So when you look at the manufacturing sector, it's quite diverse. I mean, we have various industries within the economy. Pharmaceutical is one example where we've played a very pivotal role. In the agri sector, we have played quite a pivotal role as well in providing trade and working capital solutions. So diverse across the industries. We have clients that are into plastic manufacturing, paper manufacturing. So in the various industries, based on the opportunities that we've cited, we have been very active partners in terms of providing capex and working capital solutions. So in the various sectors, and based on those examples that I've given you, around pharmaceuticals, around plastics, around packaging, distribution, and steel, most importantly. So we have some clients that are into steel manufacturing that we have supported to a large scale stuff.
Time now to take a very short commercial break. We'll pick it from there after this break.